Good day. Welcome to this secular bull market update that that I'm going to conduct today. My name is Gary Stone. For those of you who are not familiar with me and my work, and obviously I work for Share Wealth Systems, and I've been doing this big picture, long-term analysis of the stock market's secular cycles for about 6 years now. And a little bit more background is really an article that I wrote way back in 2013 that was looking at I wrote that for the Australian Technical Analysts Association, and also wrote a blog and everything about it, looking at the potential breakout that was going to occur in 2013, which did eventuate. And at the time I wrote that it was an historic event, that breakout in April 2013, which signaled the beginning of a new secular bull market, having come out of 13 odd years of secular bear market from the year 2000, when the last secular bull market ended, and then broke sideways, if you like, and went sideways for 13 years before the next breakout occurred. So we're going to have a look at that in a little bit more detail. And those of you who haven't seen it before, those of you who have, it's going to be a brief bit of revision for that long-term 30 or sort of 94, 97 year look at the S&P 500. And those of you who want more background can actually go and read up articles or look at previous sessions of this 6-monthly update that I do. Now, before we get into it, I have to tell you that everything we cover here today is of a general investment advice nature, and none of it constitutes personal advice, and it's done for training purposes and analysis purposes, and you should take it as input, as any other input you might take. You'll see I'm going to talk a bit about noise today, and if you take this at a very general level, then that's what it is. It's adding to the noise. But at the end, I'm going to talk about how to overcome noise and how to take this, if you like, and what to do about taking in this information that you're going to see here today, and applying it in a far more scientific, objective way to be able to do well in the market. So everything here we cover today is of a general investment advice nature. The objectives of this session, which, as I said, I do every 6 months or so, is to look at a really big picture view, the 30,000 bird's eye view of the markets, and where we may be sitting in the long-term cycles and trends. So I use those words kind of swap between them, but there are cycles that happen, and there's cycles that happen in all time frames in the market, looking from tick data to minute data to 15-hour, 2-hour, 4-hour, 6-hour, daily, weekly, monthly, and quarterly and annual, and even we're going to look at 4-year cycles as well. And there's also a 17 to 18-year cycle, which if you want to read up on that, you can get Martin Pring's book called Technical Analysis Explained, which is, I think he's in his 7th version or something thereabouts. And he talks of the secular cycle, which is a 17, 18-year cycle. And of course, it's not precise, and it does change a bit, but we're going to see those pictures today in action. And then to apply some technical analysis to that in a shorter term, so that shorter time frame, so that we can actually zoom in, hone in on where we're at now to try and see where we are in the cycle. Now, as I've got to say, according to our ASIC AFSL, ASIC license, past performance is not a reliable indicator of future performance. But, and you'll see that all over our website and everywhere else, as we have to, and I have to say in this session, however, cycles and trends undeniably exist. And I think the thing that surprises most people is they persist longer and repeat more often than most people would believe. And if you just have a very superficial, very high level view of the market, you don't do much analysis on it, you wouldn't know that. But the more you delve and the more deeper you get into analyzing the way the market moves, the way it behaves, which is basically human psychology in action, you will see that these trends and cycles repeat. And we're going to be looking at some big picture cycles today. So the big question, which I ask every 6 months when I do the session, is the ultra long-term trend still upwards? It's been up since April 2013, as I mentioned, Sure, it doesn't go up in a straight line. It is a long-term trend, and that's really what secular means. And we're looking at 17 to 18-year cycles, and we'll see that in a moment. So that's the question that I'm going to answer today using technical analysis and cycle analysis to do that and try and be as objective as I can. Right, before we look at all that, just to bring into perspective, it's one of the cycles that happens. It's a presidential election cycle, and this is the data from 2017 to 2027 to 1927 to 2018. And those are the averages for first, second, and third and fourth year of the presidential cycle. And that data came from Bloomberg. So well, it's relevant every year we look at it, but we're coming to the end of year 2 of the presidential cycle. And of course, year 3 is there's always high hopes for the third year of the presidential cycle. That data is a little bit out of date. There's been one additional year, or 2019 and 2020 completed, and certainly there has been year 1 and 2, which are not in those numbers. But year 3 is just on our doorstep. So let's have a look at the last year 3, which was 2019. S&P 500 was up 28.8% and the NASDAQ up 35.2%, which beat the averages for the third year of the presidential cycle last time around. And of course, we've got year 3 starting soon. No more analysis to say that, just stating what the data is telling us. Right, I normally in this session start with the wall of worry variables that are permeating around the world, that are resonating around the world as a backdrop, if you like, and as some of the big picture noise that's going on around, and people, they get sucked into this. The noise undoubtedly has the biggest effect on people's decisions in the market. They shouldn't, but they do. That's just a fact of life, because human beings are emotional beings, and then they read into, they put their own prism, if you like, on the wall of worry and the woes of the world and how that might affect them. And most of the time, it leads to pessimism. And very few of the a few times, very smaller sample, if you like, it leads to optimism. But we don't really want to be, as investors in the market, we don't want to be pessimistic or optimistic. We want to be neutral, and we want to be objective, and we want to be consistent, because that's how we win over the long term. But it pays to go through the wall of worry variables that are permeating around or that are resonating around the world, so we can form a backdrop to the discussion, if you like, and also because people take note of them. Right, government debts have been rocketing higher for many years now, and have been done basically on systemic things that the way that Western governments develop, markets develop, countries have gone, with a big emphasis on really supporting their populations and the people that need support in the population. So, but there's a lot of middle class, upper middle class handouts that happen as well, and that's been adding to debt that governments have been paying out. But there've been 2 other big factors that have been increasing dramatically over, well, one certainly happened over a 2-year period. Another one has been increasing dramatically over the last 10 years or so. And that is, the COVID happened, and governments reacted in the way they did. Whether it was right or wrong doesn't matter, but purely from a financial perspective, massive amounts of debt was accumulated, and this is over and above spending, over and above debt to the normal systemic debt that's been really growing over the decades. And the other one is climate change, which is seeing huge amounts of money, over and above spending going into, and whether whatever your view on that is, it doesn't really matter. What does matter is there's over and above spending, which is adding dramatically to debt as well, and that's really increasing the rate of rocketing that is happening with government debts around the world. And that typically has a negative effect on markets, on economies. And you might say, well, the over and above spending going into the climate change mitigation is an investment, and we're going to see the benefits of that later. Well, we don't know that right now, but the fact is the matter, there's over and above spending happening in that area. We've also got inflation, is the big topical word at the moment, and interest rates are reacting to that and rising the world over and pretty rapidly. And it's been some 30 30 plus years since we had high inflation environment. We've also got a changing, and it's one might say that the geopolitical and geoeconomic variables around the world are always changing. Sure, they are, but they're just really, it seems to have been rising at a greater rate at the moment, and there is a bit of a metamorphosis going on, and it's increasing. It's happening quicker, and so we see some of one of the outcomes of this changing geoeconomic world is the Russian invasion of Ukraine, which is a major war. Sure, there are little wars that happen all the time, and there's been a massive decline in wars over the last 70 years since the Second World War, but this is a major war. And you might look at some of the reasons for that happening, and you might have different views on what the reasons are, but the fact is it's happening. And we're seeing the weaponization of trade there in that particular situation, but also with China weaponizing trade as well. And we also have got China with a zero COVID policy, and what effect does that have on manufacturing and supply chains, et cetera, et cetera. And we also have climate change, and that is having a major effect on the geoeconomic part of the world. And some people might argue that it's political, but it's certainly geoeconomic. And as a result of these, we're seeing supply chains got ceased during COVID, almost came to a total standstill. And of course now, when these supply chains are starting to get going again, they're now subject to fossil fuel hatred. And if you think about how the supply chains, which is the major one, is shipping, and the reliance on that and transport around countries is totally dependent on fossil fuels, and how that might affect the supply chains around the world, and globalization. So globalization is getting massively stifled by these factors and many others, and the major one of which is shipping is getting affected greatly, and is with the Russian invasion of Ukraine, the kind of accepted safety net around the world is that coming to an end in a way that countries are not going to trust each other as much to do trade with them, and hence, which is globalization, and maybe looking to, at the worst case, have wars rather than do business with each other. So this is a shift. This is a definite shift that's happening at the moment, and these things take many years to play out. But how do they affect what the subject matter of today's session is, which is the stock market, because that's where we're investing, and that's what we've got to focus on. But these wall of worry variables, whilst they've been around all the time. There are always wall of worry variables hanging in the background that affect, and they have sometimes they have a big effect, and sometimes they have little effect. But what happens is the populations of the world get to accept certain things, and they get desensitized to these things. And what we want to measure, really, when we're looking at financial markets, we're not looking at the economy. We are looking at what the market is doing. And the market, if you like, is the voting machine on all of this noise that's going on around the world, and all the variables that may affect it, geopolitical or otherwise. So it's important to be aware of the stuff, but they are not variables that you should knee-jerk react to. We've got to go to the markets and the price action of the markets, because that's ultimately what we get measured on. We don't get measured on our portfolios, and our finances and our investments don't get measured on how well we can interpret the wall of worry variables. They get measured on how well we make decisions in the financial markets, and that's what we've got to focus on. We've even seen phrases like this by the Australian Prime Minister, and certainly the President of the United States, and a whole bunch of other people that are on his side of politics. That's why I've got that in inverted commas, is that democracy is being challenged. Democracy is at stake. Capitalism is at stake. That's what these people are saying now. Now, we haven't seen statements like that for many years, since going back to the Cold War. But it's important to note this as an outcome to what's going on, and as one of the measurements, if you like, one of the metrics as a result to this changing geoeconomic world. But don't get sucked into them. Don't knee-jerk react to them. We've got to go to the price action. So commentators, you're seeing noise as well. Let's talk a bit more about the wall of worry variable to do with the stock market. And noise has really hit new crescendos, if that's possible, by big name commentators, and these people typically come to the fore not when markets are, well, I guess they do, but I mean, markets are rising, but more so when markets are falling. Dr. Doom, who is famous for predicting the 2008 financial crisis. People forget that he started predicting that in 1992 and was a bear for 16 years before it actually happened. Hopefully people didn't get their timing very wrong on that and short the market for all that time. But it eventually came right, and that's what happens with these doom predictions is when they eventually come right, then people get the credit for it, but they don't get lambasted for getting it wrong for long periods of time before it happens. But his quote unquote is now the great stagflationary debt crisis is what he's now gone on record recently of saying that's his new narrative. We've got Harry Dent, the bear, the guy who's always he's probably Dr. Doom number 2 a year ago, and his timing was quite good because that's when the markets peaked. 80% decline in the US market is what he is calling from a year ago, and it's maxed out at about 25% on the S&P and 35% on the Nasdaq. So are we part way to the 80% decline? Will his prediction be right, or might that only happen in 2, 3, 4, 5, 6, 7, 8 years time? We don't know, and it may eventually happen. Remembering that the Nasdaq 100, the NDX, had an 82% decline in the 2000 to 2002 bear market, the tech wreck. So these declines can happen in major indices. Stan Druckenmiller, who's famous for working, who made a lot of money in the currency markets, a mechanical trader. His claim to fame, or when he first came to fame, was in the Market Wizards books written by Jack Schwager. And he's been quoted to saying in the last year stocks are going to be flat for 10 years, which is effectively saying what happened between, and you'll see in the charts in a moment, what happened between the year 2000 and 2013, which is a secular bear market. That's what happens when stocks are flat for 10 years. So effectively, he's saying that we're at the start of a secular bear market. And Dan Ferris is another commentator that I get some stuff from him from time to time. He's saying that the US is going to enter into a Japan-like environment. It's been 33 years now, 1989, we're sideways for decades, where Japan hasn't made a new high since the 1989 high that it reached. And he's saying, well, that could happen in the US. That doesn't mean it's going to just go sideways, and have no volatility. It'll go up and down, but he's saying we won't make a new high for maybe as long as Japan. So that's a really long secular bear market, and we'll see the longest secular bear market that's happened in the last 100 years in the US was the 1929 secular bear market, which you'll see in a moment. So there's some big negative noise happening around by respected commentators. Right, Mark, let's have a look at a couple of market valuation ratios just very quickly. I'm not going to look at as many as I normally do in this section. Federal debt to GDP, where is that? Well, it's high. It did reach a peak in COVID of being higher than the Second World War, coming out of the Second World War, which is here. That's the Civil War, US Civil War. So this goes to a long-term chart going back to, and I get this from longtermtrends.net, and you can look this up yourself. And there has been a slight decrease in that, but still at very, very high levels. If 50% would probably be a high level, we're sitting at 121%. And all this borrowing has happened just really for people living mainly, and a big spike over here in COVID, which went from 100 to 120%. But that was to fight a world war. We're not fighting world wars here, or maybe we are. S&P 500 to GDP ratio, which is being called the Buffett ratio, big picture. This goes back to the 1920s, so long-term chart, really big picture views we're looking at over here, just to get perspective on this. And so where's the S&P 500 relative to debt? Debt's already high, and a little bit of a fall off over here, so coming out of COVID, but still relatively high. That's 2000, that's the tech, that's the markets ran up massively at the end of that secular bull market. And so markets were high. So this is really a valuation on where the stock market is relative to GDP, and it's still at high levels. So this is saying that the market is still overvalued, if you like, relative to the past. The Schiller PE ratio, which is called the CAPE, and that's an averaged, so that's the blue line. And I've plotted this, and I get this off his website, Schiller, and this is updated weekly, basically, I think, this data, so you can get this. But so two things here. This is still overvalued, if you like, if you're looking from a Schiller PE ratio perspective. The long-term average is probably around about there, 25, and overshoots both ends and can stay overbought, oversold for long periods of time as well. But there has been a decrease here, obviously, with the market pulling back, and there have been some half-decent profits made as well by US companies, but still by this valuation overvalued. And we've seen this pullback happen with interest rates. So the long-term interest rates is around about 6%, rocketing up to that pretty quickly, but still an indication that we're still below long-term average interest rates. But with inflation, as we mentioned, one of the factors going on that's affecting markets at the moment, you can also see the negative correlation between these two. When interest rates rise, market falls, and typically there's usually a bit of a delay there, but that's showing it happening in real time. Right, now we're going to get into some technical analysis. So that's backdrop. That's a bit of fundamental market valuation and some noise factors, wall of worry factors happening in the background. Now I'm going to talk technically, and so the terminology that I use in these sessions is we talk secular bull bear market, and most people think secular, thinking population-wise. Not. There is a term that's used in the stock market. It's approximately 17 to 18 year cycles is what the secular bull bear market cycle is. And if you want to read up on this, Edwards and McGee has a bit about it, but the book that I've learned about this 20 more, probably nearly 30 years ago now, is Martin Pring's Technical Analysis Explained. And it's not just technical analysis in his book. He talks a lot about intermarket ratios and intermarket cycles and how they're all intertwined, and interest rates and so bonds and stocks and commodities and the whole toot. So if you want to read up on that, and there's a quantitative cycle, it's a 54-year cycle, which is another one bigger. It's 3 times 18 basically, and there's even longer term cycles than that you can look at. People have plotted 3,000 years of corn data coming out of the days of Egypt. So there's a lot of long-term cycle data around that we can look at, and at the end of the day, we've got to make decisions in the now, and how does this apply to the now? Yes, if somebody's asking, that is Martin Pring. That's correct. That's his name. Right, and then from secular, we go down to primary bull bear market, when that's typically what people talk about as a bull bear market. When it's fallen 20%, they say that it's technically a bear market, and when it's risen 20%, it's technically a bull market again. And sometimes those are called cyclical bull bear markets. And then there's secondary bull and bear markets, which are a lower time frame again, and then you can start getting into intraday, et cetera, et cetera. But those are the 3 main ones. So the big question to answer today is the secular bull market still intact? And really what it's coming down to, the wall of worry noise, if you like, and geopolitical and geoeconomic background that's going on, and market valuation and fundamentals, et cetera, they're all sitting in the background, versus the secular cycle. And the secular cycle that I'm talking about here doesn't look at any of that. It looks purely at the price action of the major indices in the stock market, and primarily at the S&P 500 to determine, purely from a price action, with all of these variables chucked into the melting pot, as to what that cycle is from an S&P 500 index perspective. And and over the years, when I show you now the charts and we look at secular bull and bear markets that have happened, during secular bull markets that have absolutely been rampant rises, there's been massive wall of worry stuff going on in the background all the time. So here's the 1930 to current S&P 500, for those who haven't seen it. And I'm just going to explain these major major cycles that have occurred very quickly. And even those of you that have been tuned in for the last 6 years odd that have seen these, it's always good to get a back to basics reminder of what the big picture is, and we step back to that 30,000 view from way up above in the sky. So the first secular bear market, which is effectively saying, people think bear markets typically go down. Well, secular bear markets mean long-term sideways, effectively, with a bit more, with greater volatility than what you get in a rising market while it's going sideways. So you see these big falls that occur. That secular bear market went on for 20 years, and then the breakout happens when you rise above the two long-term peaks. This is a weekly chart, by the way. We had even a 60% drop there that happened over 5 years. That's long term. And then we have these multi years run out, and then eventually a breakout happens. And then the next secular bear market lasted 13.8 years. Basically from that peak over there, there was a 49% fall over there over 1.7 years. And the thing also to note here is that it's difficult to tell when you've had the secular bull market running up as to when the sideways, when you're in real time, when has the sideways actually started? When are we in it? And that could take a few years to actually analyze and say, yes, we're in a secular bear market. And typically we need to see failure at a previous peak. And we're also going to see greater than normal drawdowns, if you like, or retracements that occur in the index. So you don't get 40, 50, you don't get 49, 50%, 60% falls during secular bull markets, but they do happen in secular bear markets. There was a 36% fall over there as well. And these take some time, 1.5 years, 1.7 years, 5 years there. And here we had in the most recent secular bear market, from 2000 to 2013, 13.1 years. And these are, depending on the exact definition of when they start and end, the secular cycle should be going longer than 13 years. But we had two big falls here, 49.2, 56.8 over 2.5 years, over 1.4 years. These go quite long. And now let's look at the secular bull markets, which these have gone 18 years. So the breakout to the peak and we don't know when that peak is actually forming when we're in it. And we'll talk a bit more about that now when we get to the hard right-hand side of the chart. But 18 years, 465% rise, 17.6 years, a 1,200% rise. And now we're currently 9.6 years into this breakout over here from April of 2013. And so far with the net of the retracement that we're currently in, 141% rise. We'll get a measurement on that relatively. So 141% rise in the most recent breakout, still secular bull market. We'll answer the question in a moment, is whether we're still in that or not. 9.6 years into the last secular bull market, from that breakout to there was a 252% rise, so a little bit behind on that. And the 9.6 year mark of this secular bull market over here was a 205% rise, so a little bit behind on that as well. Now, some people measure, as you know, people talk about this bull market that we're in, or some people are saying it's ended, but the whole way along they were saying 5 years into the 6 years, 7 years going to end, 7 years going to end, 8 years going to end. Well, they weren't measuring that from the April 2013 breakout. They were measuring that from the March 2009 trough, major trough. And they were saying there's been bull market from there. Now, that is true for a primary bull market. But primary bull markets or cyclical bull markets occur in both secular bull and secular bear markets. And that is one, if you like, if they're measuring that kind of transgressed both. But just measuring from that March 2009, we're now 13.7 years with a 463% rise. So let's go and measure the others to see where they were. And in the middle of that, we had the COVID crash. So if we measure the entire run up from the last trough of the previous secular bear market to the rise in 2000, then you'll see that was a 2,300% rise over 25.5 years. So one might argue that we're only just slightly over halfway in this particular run-up. And there was the 1987 crash that happened in the middle of that secular bull market. The previous one measured from the last trough back here in the early 1940s all the way to 1965. That was a 26.7 year from trough to peak and a 1,334% rise. So just trying to put into perspective where we are. Now, there's no guarantee that the current secular bull market's going to do the same. It's a small sample, unfortunately, because secular is long. it's there's only two previous samples with data that is relevant, to that we could analyze and say, well, this has some meaning. Now, there are no guarantees. We can't predict the future, but it's just putting a big picture view on where we are, using the cycle analysis, the secular bull bear market analysis. So Nicholas is asking, does this correlate to the 18.6-year property market? I don't know. I'm not an expert on property markets, but I suspect cycles do occur there as well. And that is also, there was a 28%. So during the secular bull market here, made the biggest primary bear, if you like, was the Kennedy slide in 1962. Right. So that's kind of set the big picture. So you can have a visual 30,000 feet visual of secular bull and bear markets that have transpired over the last 96 odd years. So now we're going to start looking at start doing a little bit of other analysis. This quote is, I think, one of the greatest quotes around in terms of trying to put some English, some word cycle, if you like, on bull markets. And these bull markets could be secular, they could be a primary, and it could be secondary. Is that bull markets are born on pessimism, so they start when there's blood on the streets, if you like, and then they're grown on skepticism, mature in optimism, and die on euphoria. Now, I've been on the record for the last 6 years saying that in one of the things that we should look around, if you like, and try and get a subjective feel on is whether there's euphoria around, because euphoria and euphoria is really used in the sense to be positive. The other side of the total despair is in the negative side, pessimism, if you like, and they die on euphoria. Have we had the kind of euphoria that existed in 1998, end of 1998, and through 1999 into the beginning of 2000, with the tech run up? Have we had that euphoria yet, if you like, in this run up of the secular bull market? My answer to that is no. But do we have pessimism? We have pessimism around. So the pessimism around at the moment, might be defining the start of the next primary bull market. Have we had enough optimism, really from a secular bull market perspective, to say that we're in the latter stages of that secular bull market? Again, I would argue no. So are we still in the skepticism phase? Now, it's very difficult to actually pinpoint exactly where we are in those four phases, but we are somewhere between. We've had optimism, there's no doubt about that, coming out of COVID in 2019. There was huge optimism as well. So you might have said that could have been the maturing of the secular bull market. I'd argue they were more the maturing of the primary bull markets that were occurring then. So in the secular phase, the long-term, ultra long-term bull market, my view, my personal view, and again, there's a lot of wishy-washiness around this, and I do prefer objectivity than subjectivity, but it's a little bit of subjectivity over here, is that we are still in the secular bull market sense, still in the skepticism phase, and it's still growing. And I'm sure my view on that is comes a lot from the charts I've just shown you. But one thing we can say is that in the secular, the long term, we definitely have not had the euphoria that we had in the last 18 months to 2 years, of even the last 5 years of the 1995 through to 2000 ending, if you like, of that last secular bull market. So, but it's a phrase that I keep bringing up every 6 months, and I use in these sessions just to remind our clients to step back and see the big picture, and at least take this into consideration, and not just the short-term noise that creates the volatility in the market. So let's analyze the secular cycle. Now, analyzing the secular cycle, it's easy to determine the start of the secular bull. And on the charts I showed you, getting that breakout above major peaks that have formed over the last 10 to 13, 14, 15 years, and that breakout, as I wrote about in April of 2013, that's relatively easy to do if you have this big picture view in your head, right? It's a far more difficult thing to determine the end of the secular bull. And sometimes you really only have that confirmed when the previous peak is not surpassed. And that could take 3 or 4 years before that peak fails and we head down further. And you can think of the last, just looking at that big picture view of the 1930 to current S&P 500 chart, is when those failed. And that could be happening right now. And we'll look at some shorter term charts in a moment, but it's more difficult to determine the end of a secular bull. But we're going to look at some techniques now that we can keep an eye on and just be vigilant of over the coming months to see if they actually reoccur like they did in the previous two starts of secular bear markets. So what we're going to be looking for objective signs, as objective as possible signs, to alert the end of the secular bull market, and that we may be transitioning into a secular bear market, like some of these Dr. Dooms and some of the eternal doomsayers and fearmongers and negative people are saying. They are eventually going to be right. There's no doubt about it. And then we're going to move into a secular bear market. What we don't know is when. And we want to, rather than go on predictions, we want to look at data and be as scientific and objective as we possibly can about it, rather than just reacting to statements. So let's look at some long-term technical indicators now. Then we're going to look at some sentiment indicators. And one that this was brought to my attention in my early days in joining the Australian Technical Analysts Association back in the early 90s. I can remember somebody talking about this, and then I forgot about it and looked at it again. And I've recently been brought to my attention by some other longer term people, that other analysts that look at long term views, and it really does look objectively like one of the long term technical indicators that we should be keeping an eye on. So what I'm going to do is track back here to this is going back to 1929, 1930 on the S&P 500, bottom left over here, during the secular bear market that you saw on that chart. And this is a 14-month RSI, relative strength index, Wells Wilder. He devised this back in 1970, in the 1970s, and wrote a book about it. But effectively, you've got these upper and lower limits. These lower limits are in the mid-30s, the upper is around about 80 on a 14-month RSI. And during secular bear markets, you see that the 14-month RSI transgresses this bottom line, which I think I've got set at 36, and battles to get above the upper limit, which is set at 80. Now, that's a subjective call on where those should be. And it's, sorry, somebody's asking, what is the name of the book again? It's Wells Wilder, New Concepts and Technical Trading Systems. He devised the RSI, and he also devised average true range as well, and a few other things. So that was an indication, if you like, a confirmation that we were in secular bear market territory. And then we had the secular bull breakout, and that rise to the next secular bear over here. So at the beginning of the secular bear, what we're looking for, remember, are signs that we could potentially be going into a secular bear market. So during this entire secular bull market, the RSI, the 14-month RSI, did not transgress, did not fall below this bottom line over here, and then but it did get above the 80 line. So there's a bias towards the upper part of the RSI and staying away from the lower part of the RSI. And so there were some transgressions here. Early on at the beginning of that secular bear, we started seeing the 40-month RSI fall below the 40-month RSI. So the thing now, without looking at the right-hand side over here, let's just focus on the middle part of the chart over here, is typically it would take this long between that peak there. So you can see that peak, the market rose above it. So we're still in secular bull market. Then we have a fall, which was about 36%, if you recall from the previous charts. And then we have a rise, and it fails. There's a slight extension of the range over here, and then fall. So that peak failed to be transgressed, if you like, in a breakout type manner, like it happened over here. And then we fall back into the range and then have a big fall, which was 49%. So it would take that long, if you like, to say, hang on, that the rising above that peak has failed. We're now in a secular bear market. So we're looking for signs to not have to wait for that, we want to know in this particular, because we're in a 25% max fall so far on the S&P 500. Is this a start? Are we in this particular part over here of the long-term analysis, or are we still in a secular bull market, just having a retracement, a normal retracement in a secular bull market? That's really the question we're asking at the moment. And what we saw over here was there was a transgression. There's an early transgression over here that happened on that trough, went to a new high. That new high had a lower high on the 14-month RSI. And then at that trough, we had a fall below the 14-month over here. Basically, at that trough, rather than waiting for that peak, we could have said the odds are that we're in a secular bear market at this stage, right? And then you can see what happens there, very similar to what happened over here. A number of falls below the bottom line and failed to get above the upper line over here. So if you like, using a technical indicator, not just looking at price action, using a technical indicator here, which is a derivative of price action, to be able to get an insight into what's happening. And then we had the next secular bull, which was from breakout to top, was about nearly was over 1,300% rise. And then we had, on the way down, the first run down, we started seeing a transgression here below this bottom line. Early signs, rather than having to wait to see if this peak isn't taken out by the next rise up. Here, early signs that we're potentially in a secular bear market. And if we then take to current, you can see then fell below, failed to get above during the secular bear, fell below again during the secular bear, and then the secular bull has started, and we've risen above the top line, the top limit line, but are still above the bottom line. So here is one insight. This is one thing that you can take away from here now, is to look for, if we do go lower on the S&P 500, to see if the RSI, the 14-month RSI, falls below this lower limit line, which I think I said this one, I think set at 36, but you could play around and just, if you've got technical analysis software of your own, certainly, and beyond charts, you can set this up, and our clients will be able to download this analysis the next time, or after today, we'll upload all this analysis, and you'll be able to pull it down and see for yourself without setting it up. But what we're looking for is this to happen over here, to get a fall below 2, if we are looking to see if we were in a secular bear market or not. Now, if the market rises from here to take on, to potentially challenge the last peak, and this stays above, then, and again, it's small samples, but when you're looking at long-term cycles, unfortunately, that's just the reality. We can't create data out of nothing. And we have to go with that. So there is one sign, if you like. It's not a dead cert. It's not a 100% guarantee that anything is going to happen. It's an indication of probability that we can take in that is a bit more scientific and a bit more objective than listening to people's statements from around the world. So let's have a look at that on the Dow Jones as well, and we can see a similar thing happened. In fact, on the Dow, we got data back to 1896. So here is the late early 1900s to early 1910s. There was a secular bear market there, and you can see the 40-month RSI there. There was the 1929 through to 1949, I think the breakout was over there. Again, 40-month RSI occurred, and again over there, here was one false breakout below that occurred. So we could have a false, that could happen now. We could have a transgression below the lower line on the S&P 500. It could be false. But and why was it false? Because it was there. I think that was the Kennedy slide, and it did. The market then rose and went above that particular peak over there, which we said, okay, all bets are off. We're still in secular bull market mode over here. And then the next trough that we got started falling below. Then secular bull market. Then we had the secular bear that whole time. Secular bull market got above the upper line. And then we had this transgression below on the Dow Jones. We had happened on the S&P 500 as well. Confirmation at the bottom of the first trough. So this has got some, it's got some credence behind it. So where are we now? Let's just have a look at where we are now. And on the Dow, have not fallen below the 40-month RSI. So using this particular one indicator as an input, it's still okay. Let's have a look at the NASDAQ. We don't have as long a data on the NASDAQ. So going back to the 1970s, And so the data started during that particular secular bear market, was well below, and then we had a false breakout over here on the Nasdaq in what is that 1990 or thereabouts, but then above, and then we had this. So it's worked. It certainly worked on the secular bear market that we had from 2000 to 2013, failed to get above, and where are we now on the Nasdaq? Still above, but closer to that lower limit line than what we are on the S&P 500. So still using this analysis to try and get an insight into this retracement we're having here, is the similarities to what happened in these retracements back here at the beginning of the last secular bear market. So it's okay at the moment on those three indices. Not enough data to really do this on the all ordinaries, which have only got data from 1992, and I think it only really goes back, those of you who have longer data, real data goes back to early 1980s, also still not long enough because it's only got one secular bear market in it. And I know there's constructed data that goes back longer, but it's pretty constructed where they combined all the major city, the Perth, Australia, Sydney, Melbourne, they combined all those particular exchanges. So not enough data on the ASX to do it. Okay, now let's just go to another long-term technical indicator, COPOC, which is one I learned about at the ATA back in the mid-90s, as well as a long-term technical indicator, one that Colin Nicholson used to use a lot. Effectively, I just got this on the S&P 500, and I've got it only starting in 1990, but you can take this all the way back. Effectively, the way the COPOC, it's also a 14-month indicator, and you can look this up, and most technical analysis packages have it in it, but effectively, the entry signal is when it crosses from below to above the zero line, and the exit signal is when it crosses from above to below on the zero line. So those are the cycles, long-term cycles on monthly data. And you can see it actually, timing-wise, works relatively well, where you're in for big chunks and out for big chunks, and the entry signal occurs at a lower level than the previous exit signal, but long-term stuff. So where is that now? Well, it's only just fallen below. Now, does that mean it's going to go way low like it did here in 2008? Or is it just going to do that? Difficult to tell, but it's one input. It's a long-term indicator, if you like, on using price action. Is that right now that is negative, as most indicators would be negative. Why? Because we're sitting in retracement territory at the moment, and the markets are not rising. So that is another long-term indicator that you could keep an eye on as well. Okay, let's go to some sentiment indicators now. One of the sentiment indicators that I've looked at over the years, but not really spoken about much in these sessions, is the CBOE equities put-call ratio volume, the volume of the put-call ratio. And this is the VIX is based on put-call ratios as well, and there are lots of other indicators around. But one of the things that's been brought to my attention over the last few months is how you would use this data, because it's pretty dirty data, just because it's got daily measurements in here. And this is a daily chart, is that you put a 250 to an annual moving average on it, and it's just a simple moving average. And then what I've done, which others don't do, is I've just put a long-term exponential moving average on that simple moving average, just to get these long-term cycles. So this goes back to 2008-9, and effectively this is a contrarian indicator. So these values are high when there are more puts on. So effectively, then when the puts start coming off and the calls start coming up, then effectively that's saying that people are more bullish. So it's more like a contrarian indicator if you're looking at where this simple moving average is placed. So effectively, you buy when this indicator starts falling. So what's that indicating? It's indicating that there are more calls out there than puts. People are buying puts to protect their portfolios. So when there's more puts being bought, then this will rise, meaning that is a negative cycle. So these dates you can look at, and you can actually correlate them to what happened on the markets, and it's pretty damn close to major turns in the market. So buy, sell. So when it starts rising, you sell, more puts coming on, and so it goes. So where are we sitting at the so what we're looking for is at the end on the right-hand side over here, there was a sell signal, if you like, that occurred back in December of 2021, which is not that far off. It's pretty good. What we're looking for is this to start topping and turning again. So like the copper indicator, this is still trending up, meaning that there's more puts on, so people are more negative than positive. And we're looking for transitions, changes from one to the other. So this sentiment indicator is very much showing that sentiment is still negative in across people that are protecting portfolios. Another sentiment indicator is to look at consumer discretionary versus consumer staples, to see people are spending. So when people are bullish, are positive about the economy and positive about their lives, then they spend, and so that's discretionary spend. So the discretionary sectors look at stocks that are high in discretionary spend, and of course staples are stocks that are needed in day-to-day living, regardless of what's going on in the economy. So what I've done over here, the top line here is the XLY, which is the consumer discretionary spider, which sector, if you like. It's and you could go to the, as I'm going to do in a moment, you could go to the base indices. Here I'm just using the ETF, the sector ETF, which is XLY in the US, and we'll have a look at the Australian in a moment, and just put some support and resistance lines on here. But you can see up until this period of time, towards the end of 2021, consumer discretionary was outperforming. So what have I done here? This middle chart, which is not that it's relevant in that it's a ratio between discretionary and staple sectors, is that when this blue line is rising, then people are spending more on discretionary than the staples, and you see those stocks, if you like, reacting better profits, etc., etc. But sometimes it's difficult just to read the raw price action, and it's also difficult to read the relative strength line, and it's also pretty dirty, if you like, pretty volatile, pretty messy, and put moving averages on, etc., etc. So what I've done, and I do this quite a bit, my own analysis, is I've put a CIROC on that moving average, that green moving average. So that's the ratio. So that is the relative strength. The blue is the relative strength line. Then I've smoothed the relative strength line by putting a longer term moving average on that, which I've used an 89-day exponential moving average, which is effectively a Fibonacci number, 55 plus 34. And then I've taken a CIROC of the green line of the moving average to smooth things out, to try and get these turns. So you can see the timing on this is relatively good in terms of discretionary. So when this is rising, when the CIROC is rising, then discretionary is got the upper hand in terms of the stocks, the discretionary sector, and that's an indication. It's a sentiment indicator of what's happening in the economy. And so when the CIROC is rising or up near the top over here, that's good for that's risk-on type environment, and you would have exposure, increase your exposure to stocks. And then, of course, when it starts falling, and that means that discretionary is coming off and staples are rising. So now you could have a situation here where discretionary is falling and so is staples falling. But what we're looking for from a relative strength perspective is that discretionary is falling by more than staples. And so staples are holding up. That's obviously a conservative investing sector, are the staples. And that's certainly what's happened since this peak over here at the end of 2021. And that is, you can see this going off. Now, what has happened is the CIROC, the smoothing of that moving average, is showing that staples are still in control over discretionary. And what we're looking for is this to happen. We're looking for the CIROC to rise out above 10. We've got to oversold situations over here as an indication of risk on, time to put risk on. So certainly this sentiment indicator is saying, let's still hold back. It's not time yet. And if the discretionary stayed in the doldrums for a lot longer, then the CIROC indicator would still stay down below there. So this is a sentiment indicator. And if you go back and look at this over the long term, there are times where discretionary and staples get out of sync with the market. So you can't use it as a timing indicator all on its own. It's one of the sentiment indicators that you can take into consideration in your analysis. But effectively, what I've shown you in the RSI, the 40-month RSI, the COPOC, and these can give you a really good insight into the price action that's happening in the market and the necessary sectors to give you an insight into when you should be getting into the market and when you should be getting out of the market. And as your analysis skills grow, you'll become less subjective and more objective, and you can build rules around this if you want to. So let's have a look at another sentiment indicator, look at discretionary versus staples on the Australian market, and it's pretty similar. These timing signals are pretty good. Even in COVID over here, it was relatively, the turn was relatively quick, but there are times that it does get out of sync, as I said before. But just looking at it recently, discretionary being certainly since COVID has been on the rise, and now we're seeing this fall. And where's it in the Australian market? A little bit more sensitive. Discretionary is doing a little bit better. And if this continues, you might see this breakout above 10. Could there be a false breakout? Sure, there can. But the long-term smooth nature of this, it tends to stick around for a while. So still too early according to that sentiment indicator. The other one is to look at NASDAQ versus the S&P 500. Done the same thing, relative strength. So when the NASDAQ was really outperforming the S&P 500, it's time for risk on. That's typically your tech stocks and your biotechs, and that are doing well, and they have huge run-ups. And this is the NASDAQ composite, not the NASDAQ 100. So similar, it's the NASDAQ is underperforming. There's the relative strength line falling. The blue line is falling, meaning NASDAQ's doing worse than S&P 500 and still down here at low levels. So to get a risk-on environment, you want to see the stock rising up on the right over here, the sentiment indicator. Growth versus value is another one to look at. Similar things. The philosophy behind it is that growth stocks do better during risk-on environments, and value stocks do better during risk-off environments. And if you go back and look at this in more detail, you'll see that there are some cases that's just not the case, where growth underperforms value in a rising market, but most of the time growth does outperform value in a rising market. And you can see here I've got a base 100 going back, I think it's 1993, and the top line here is growth versus value. So growth over the long term smashes value. There's no doubt about it, but it has a more volatile ride. And we want to pick the times when growth is outperforming value as a high probability time to have our money in the market. And you can see that right now the growth is underperforming this S&P 500. This is the 500 growth versus 500 value stocks. Those that make up the S&P 500 that are compartmentalized into growth and value, and growth is underperforming value at the moment. Another sentiment indicator. Another one is the AAII investment. That's the American Investors, the American Association of Investors. I can't remember what it is, but they've got millions of members, and they do a survey quite regularly, I think every month. And you can see here that this typically is a contrarian indicator, and when markets get oversold like they did here back in 2008-9, they typically do well thereafter. And we're starting to get to an extreme now in this particular time where the AAI members are getting very, very bearish. So this is a bearish reading, and the more bearish they get, the higher the probability is that we're getting to a turn, at least to maybe end the primary bull market, or to end a primary bear market and potentially start a primary bull market. But again, this is just another indicator. There's no dead certs over here. This is just all of the culmination of indicators we can look at to get a feel for where we're in the market. So there are certainly some indicators that are showing oversold, and there are some indicators that haven't turned up yet. So it may still be a little bit early. Right. Now, a lot of those are subjective, and as all of you or most of you know, Share Systems is about being objective, and we need to make decisions on the day. We don't want to willy-nilly pull all the stuff in, be subjective, and then still allow the noise to overrule sentiment indicators or price action or whatever we're looking at. And that's typically what happens. The emotional loud noise typically gets us to make decisions that are not in our best interest. And even though we might get the decisions right sometimes if we rely on noise and emotion. It's not about getting the odd one right here or there. It's about being consistent and just getting the ones that we get right, we stick with, and we put the noise aside, and we go with something that's more objective and scientific than emotion. And that's really what investing is all about. So what we've done now, and I'll just mention in a moment, we've devised a sentiment risk indicator that is more sensitive than the market risk indicators that we currently use on the indices, and really to be used as a portfolio sentiment risk measurement rather than a market risk measurement. So, and there'll be a bit more of this coming out over the coming months. But I just wanted to show you that now because it's kind of done and locked in and it's busy being programmed at the moment. But what this sentiment indicator is showing at the moment is that it's still risk off, and this is on the NASDAQ, is that it's still risk off at the moment. And what we'd be looking is for this to rise. And it's, as I said, it's a bit more sensitive than the market risk. And it would have you in the market more often than what the market risk on the NASDAQ would have at the moment. And it'd also be more sensitive to getting out as well. So it's somewhere in between. It's a bit of a Goldilocks sweet spot, we believe, given all the research we've done over the last 2.5 months on it. And how we've tested this, well, we've simulated portfolios to see which sentiment indicators and market risk indicators would do best for a SPA3 investor portfolio. And we've devised the sentiment risk indicator to do that. So a lot more coming up, but I just wanted to, now that I'm talking about sentiment risk, I thought it'd be relevant for our members to show where that is at the moment. Okay, let's talk a little bit about support zones before I sum up. We're just about there. So let's just look at the major support zones on the S&P 500 at the moment. So first thing, I've got a Fibonacci here from April 2013, the breakout. So this is a Fibonacci line running the entire duration of this secular bull market since it started back there in 2013. And what I'm trying to do here is get a relative measurement on the retracement that we've had. And we are sitting at a 38.2% retracement of that breakout. And if you go and analyze, which I did in the last session back in May, when I did this the secular bull market update, is that it's okay to have 38.2% retracements from the breakout. It's even okay to have a 50% retracement, which would mean the S&P 500 falling down to here, which is about 3,200, right? So we're sitting on this support level, and we would like 38.2s are far better. And if we find support here at this 38.2%, and it also coincides with a pretty strong support resistance zone over here, which has a number of touches, then we would say this has been healthy. A 38.2% retracement in a secular bull market is a good, healthy retracement, cleans out everything and sets up for the next run. That's if the support level holds. Now, I'd be willing to say, to go, okay, a 50% retracement would be okay, which would take it down to 3,200. And that would be another 600 points from where it currently is, recognizing that this trough, the last trough there, which is lower than where we are at the moment, was a 25.3% fall. So remember I said 25 to 35% falls in a secular bull market is okay. It is okay. And it sets up for the next primary bull that within the secular bull. But if we had to get to a 40% fall, then which coincides roughly with a 61.8% retracement, then we're starting to get a bit iffy. And if we get to a 40% retracement, it would take us below the pre-COVID peak. A 50% retracement would get us to round about the pre-COVID peak, which would be a decent retracement. But falling 40% takes us below the pre-COVID peak, and I'd be saying that the odds there are now of getting to a 50% fall, which would, by definition of all the previous secular bear markets we've had, is that we would say we were in a secular bear market if that happened. So at the moment, we do technically need, despite the sentiment indicators I've shown you and the RSI 14-month and the COPOC and that sort of thing is just zooming in a bit more over here. We do need these support levels to hold and would be prepared to go to 3,200 to say, yes, the secular bull market is still intact. But below that, it would really start testing the bounds of this secular bull market continuing. Let's just have a look at the NASDAQ on that. The NASDAQ has had a maximum at the trough that happened just a few weeks ago, a 35.7% fall. And that it's currently at a 50% retracement from the breakout that occurred in April 2013 to the peak there. And so it's much closer to that 40% zone. Now, remember, in 2008, during a secular bear market, the S&P 500 fell 56%, but the NASDAQ 100 fell 82%, and the NASDAQ composite fell 72%. So it is going to be more volatile in primary bear markets, which is what we're currently in at the moment. But the 40% is a 61.8% is greater than a 61% retracement. So a 40% fall would take us to 9,727. The 61.8, which is the pre-COVID, is 9,358. So to get to that 61.8% fall would actually be more than a 40% fall. Now, if that had to happen, the S&P 500 would be less than 40%, and the NASDAQ would be more than 40%. So that would be, we'd have to see what happens at the time. But I guess what I'm saying is that the S&P 500 is the one that we've got to go on here. That's what we've looked at the long-term data. But you might see, if the S&P 500 gets to that 50% retracement, that 3,200, you might see the NASDAQ going more than a 61.8. But I would be making my call on the S&P 500, not the NASDAQ. But just needed to give some positioning on that as well. So where to from here to sum up? The decisions we make control us much more than the conditions we meet. So I've spent all this time here on talking about the conditions that we're in. Sure, I've given you some insights into the decisions you make, but those decisions and sentiment indicators and that are still a bit wishy-washy. Some of you might be hearing it for the first time. And what are the odds of you, bringing that into analysis and making decisions on that? I'd say pretty low. I'm not a product of my circumstances. I'm a product of my decisions, Stephen Covey. I mean, really what these two guys are saying, and I'm sure every single one of you have heard of both of them, is that it doesn't matter what happens. It's how you take it that counts. Shit happens, bad things happen, good things happen. And it doesn't matter it doesn't matter the volume of either good or bad things that happen in your life. It's how you take it and what you do about it that counts. It's all that counts. And it's the decisions you make around those. And that's really what we are on about here in the stock market, is that putting a decision support system, a regime, a process, whatever it is in place that allows you to make objective decisions that can stand the test of time. That's really what it's all about. So what are the thresholds to watch for to summarize this? Well, look at the support levels on the S&P 500 and NASDAQ. Look at those Fibonacci retracements, the 50% or even the 61.8 plus on the NASDAQ. But really the percentage falls do count here relative to what's happened in previous secular bear markets. So keep an eye on those levels, which I've just covered then. Then also look at the percentage levels. 20 to 35% declines are okay for a secular bull markets, but more than 40% declines are not okay. So if we get that on the S&P 500, the odds start changing greatly towards us, this being the end of the secular bull market, but that hasn't happened yet. So if that happens, the high probability will go to high 40s, maybe even low 50s, and on the S&P 500, which should really say the odds are that it's the start of a secular bear market. And what would happen is the 14-month RSI at those sorts of levels, I think would be a very high probability to drop below the lower limit line, which would be indicating what happened at the start of other secular bear markets. So keep an eye on the 14-month RSI and look at those sentiment indicators, the relativity between discretionary and staples, NASDAQ and S&P 500 and the like. And they give you an insight into measuring sentiment, and certainly the sentiment indicator that Cherwell Systems is going to release over the next month. And also a much longer lagging is stalling at the last all-time high. Now, the all-time high that's just been reached back in a year ago, the quicker that gets challenged, the higher the probability is that we've got a secular bull market going on, continue. If it takes a long time to get back to that, like I'm talking, 2 or 3 years to get back to, maybe go a little bit lower, maybe don't transgress, the 35% and start heading to 40% and then go higher, then take another 2 years to get to the peak that we reached last year. The odds are, the longer that takes, the greater the odds are that we're in a secular bear market. So keep an eye on if the market might not, it's certainly going to be a when. It's just a matter of how long that when is. Is that the November peaks are challenged again, how quickly it takes us to get there, and what that challenge looks like on that last all-time high. If we stall there and can't break through there, then we fall away. Odds are, it's secular bear market that we've got coming up. So the secular bull market, from our analysis, I'm sure you picked up, is still intact for now. But where to from here? And we can't predict the future. So do we want to predict, doubt, hesitate, react to noise, the doomsayers, all the wall of worry, geopolitical, geoeconomical stuff happening out there, and keep changing the basis for our decisions? Sometimes it's based on noise, sometimes it's based on what I say, sometimes it's based on some YouTube video you watch, sometimes it's based on the Channel 9 news commentary on finance, on the financial market, sometimes it's based on your financial planner or whatever? Do you want to keep changing the basis for your decisions, or do you want to be consistent and objective? And that's really what you need to do, is prepare a plan and trust it. And for those of you that don't have a plan that can take into consideration the varying market conditions that we go through and make objective decisions of what to do in terms of exposure to the market, either increasing it or decreasing it, or 100% or none, then that's really what you have to do. And there are ways of doing this, and that's really what ShareWealth Systems does. So prepare with a plan, not on the fly prediction. This is another quote that I use often, and I repeat it every 6 months: is expect the best, plan for the worst, and prepare to be surprised. Now, the order in which you do that is you plan for the worst, expect the best, and then prepare to be surprised. So in planning for the worst, what is the worst could happen? The worst that I put in question mark is that most people say that this long-term Japan-like situation, or the 10-year sideways, as Druckenmiller is saying, or the stagflation that Rabini is talking about, or the 80% decline that Harry Dent's talking about, is that the worst? Because all of that defines secular bear market. Is that the worst, right? So what are the best? Let's think about it. Let's prepare for the worst. Let's see what are the best strategies for a secular bear market. Have a think about it. Is it buy and hold index ETFs? Is it buy and hold stocks? Is it buy and hold balanced funds? You saw what happened in COVID-19. There was a massive run to cash in the super funds. People were taking out a balanced and aggressive funds within the super fund umbrellas, and they were going to cash, so much so that the super funds couldn't realize the cash. They had to go and sell assets to be able to realize the cash, right? So what is the best strategy for a bear market? Well, I'll put to you, the best strategy for a bear market is that you can actually increase your port, rather than just going sideways and not having any growth, or maybe only getting dividend growth over the period of maybe 10 to 13 years in a secular bear market, is that timing can actually grow your portfolio over that long term. So you end up with a net increase rather than just going sideways. So I've got a question here by Bob. If the bear market takes hold, would the SPA3 systems still work? Yes, they would. And how would they work? They work by timing with a statistical edge. And how do they do that? Well, they avoid the large primary bear market periods, most of it, not all of it, during a secular bear market. So we avoid, if you think of the picture I showed you, the 250% declines that we had in the last secular bear market from 2000 to 2030, we avoid most of those. And then we minimize, so we don't avoid peak to trough, but the big chunk of it, which gets you to outperform the market, and then you make the most of the primary bull market periods during the secular bear market. And there you maximize exposure. You want to be 100% invested. When the NASDAQ from 2003 through to 2007 went up 150%, as did the ASX 200 or the All Ords, then you want to maximize those times. So that's what timing does. Now, in an index ETF, you just go sideways that whole time. So we just completed. So somebody said, can you give us an update on the release of the changes to the improved? I certainly will, Don. I'm not going to do it now, but we hang in there. That's imminent. We are certainly going to do that. Thanks for that, Paul, for what you're saying. And Tito is asking about, so I'll get to all that stuff, and I'm not going to do it today, but let me just finish over here, is that this research project is now being coded as quickly as we possibly can. We are going to be doing, and you'll be getting email on this very shortly. We've got all the venues now booked, and flights have been booked for us to come, Dave McCullough and myself, to come around the country, starting in Perth and finishing in Melbourne over a period of 2.5 weeks, to do the live Connect and Grow meetup sessions. And it's going to be the research we've just done is going to be obviously one of the major topics on the agenda for that. And we've got development team. We've got the testing cycle will start in the next 10 days or so, and we'll go through the testing cycle before we release the software. But we want to try and time the releasing of the software with us doing the roadshow to all our members in Connect and Grow meetups around the country. So that said, you're going to get an invite for that shortly. What we've done is we've looked at the last 12-month data set of this market, and in my technical analysis and opinion and view is that the last time that we had this kind of market was in the early 60s and in the late 60s and the early 70s. of which we can't compile portfolios. But it's been a really interesting research project that we've done, and we've looked at not just the 12 months, but obviously put that into perspective with 22 years prior to that, and done massive amounts of simulation and testing of different rules. So what's come out of that is we adding a stock price filter to the individual price entry signals, and there's also an optional portfolio sentiment indicator which you can use, which is more sensitive than market risk, and we'll be talking all about that in the coming Connect and Grow sessions. So the emphasis is on avoiding primary bear markets. So if we do head into a secular bear market, if it started, we'll know in the next year, probably 6 months, 6 to 9 months. If we have started a primary bear market, we want to be prepared for it, and we're going to take a more conservative view on risk management at a stock level, but certainly at a portfolio level as well, to be able to get that growth during secular bear market periods. Of course, to everybody, I just can't emphasize enough the need for you to do your own investment plans. We've got lots of templates in our education center, but the investment plan is not so much the writing of it, it's the thinking and the planning you do to actually write it that is the most important thing. So really, I impress upon you. I know we've got new members battle to do it. You've got to do that. Even relatively older members that have been with us for a few years now, I know that the 20-year plus members all have investment plans, but sometimes it takes a few years to get there to do it. I impress upon you, now's the time to do it when we're in times of adversity, rather than when the markets are rising, because this is when we really get tested, and we want to, we need to react to it. Doesn't matter what happens, is what we do about it. And we'd like to think we've done something about this pretty, this 12 months data set of primary bear market that we've had, so we can react to it. Okay, just for those of you members who haven't read this book, 15% per year and 15 minutes a week, it's in the education center, and for prospective clients who get to see parts of this recording of this, you can go to that website and you can get a copy of it. I'll come to some of the questions in a moment. So in summarizing, the secular bull market is still intact from all the analysis techniques that I can look at. And I'm not going to predict whether the market from here is going to go lower or turn around and end this primary bear market and start moving into a primary bull market phase. I'm not going to predict that, but I can tell you the secular bull market, by all the analysis that I've done here today, is still intact. But anything could happen. It could end this year, or it could go the full cycle to 2030. Despite all the wall of worry noise that is around in the geo and the changing of the geo-economic environment that we have. But you do not need to know what will happen next in order to make money in the markets. Mark Douglas's fundamental rule number 2, and anything can happen, is number 1. So those are 2 really important things that you need to keep at the back of your mind in everything, all your endeavors in the market. Expect 10. I've been saying this for the last 5 years at least. Expect 10 to 35% falls during a secular bull market, and we've had one in COVID, which went 33%, and then we're sitting another one at 25% on the S&P 500 and a 35 on the Nasdaq. So we've had 2, but secular bull markets, the previous 2 have had these kind of falls in them, and we've had, with COVID being a bit of a slush ball, they've happened pretty close to each other. In the early 1900s, there were 40% plus falls in that secular bear market that happened within 10 years. So these things can happen. So it's all about risk management first, then probability to profit second. And it's highlighted even more in a secular bear market than what is in a secular bull market. In a secular bull market, you can get away without applying a sentiment risk or a market risk or a portfolio risk type filter on your portfolios, and we've enjoyed that for a big chunk of time. But in a secular bear market, the onus is there more to use a portfolio risk management regime as well. And we did that with SPA3 Trader. We've got risk profile 1 and we use market risk. In SPA3 Investor, we're now going to introduce as optional a sentiment risk, and I'm calling it sentiment risk as opposed to market risk because it is different over the portfolio. So that's what we're going to introduce. So the best way to take advantage of this opportunity stream is to deploy an evidence-backed statistical edge, a mechanical decision support system that has researched entry and exit and its timing. So it's all about being mechanical, it's all about being consistent, and it's all about being objective. And then also to spread your investable capital across multiple strategies. Right, some questions here that I didn't answer. So the ones from Don and that I'm not going to get into the details of that now. That's all coming up. It's by this time next month, it'll all be out there. It would have finished all the Connect and Grow meetups, and all the software would have been released by the 9th of December, and we'll be using the outcome of that research. Paul is saying, I'm fully committed to SPA 3 investors, so I don't care bull or bear market. I just want to beat the market, which hasn't occurred for my portfolio over the last 3 years, still hoping things to improve. Certainly the last 3 years have been tough, but over the longer period of time, and more so in Australia, Australia's done better than US as SPA 3 investor. Hi, Gary, I'm wondering if applying the ATRTS to the VIX, be wary if VIX trending above. Tito, no, I can't comment on that. Just off the top of my head without looking at it and seeing what the outcomes are, it's a bit too volatile. But you could try. You could certainly. There's enough data there for you to devise your own parameters using average true range on the VIX. Graham's asking, do you have spreadsheets for buy-sell trades to use for tax as well as understand trade history? Yeah, we have it sitting. We have all the trades sitting in a portfolio manager, so we've got our own inbuilt portfolio manager, Graham, and that can certainly be used to output and export and things like that. Nicole's just saying try a share site, but with all the transactions in there, I'm sure most portfolio managers, there are not many around, decent ones around, but certainly our portfolio manager, you can export all that information. Right, could you please video the meetup so people who can't attend can see it? Thanks. Deanna, absolutely. We will, as we did last time, we'll be recording all the Connect and Grow meetups. I think we typically get somewhere between 250 and 300 of our members around the country attend them live, and then for the rest, we record them. Dave and I record each session, and we make those available. So that's that. In fact, we're going to use that. The first one is in Perth in a week and a half, on the Tuesday a week, and we'll use that, the recordings that come out of those sessions. We'll use the best ones, if you like, to get around to the rest of our members. So thank you for your attendance today. Hopefully you understand where we are in the secular bull market cycle. I've enjoyed doing the analysis and the preparation for this as much as I've enjoyed giving the session. So we'll be back with some more Connect and Grows. Keep an eye on your emails, inbox in the coming weeks. Thank you for your time and attention. And as always, I wish you objective and consistent investing.